Greetings and salutations. Winter is coming, or maybe it has finally landed here. We've been spoilt over the last 2 months, September, October, and now halfway through November she hits. So hope you're safe and well wherever you are in the country slash world. This week, I'm bringing you something slightly different, but maybe I say that every week. I don't know, but I do hope it's going to be an interesting one for you. Certainly, an interesting one for me. Investment options, and also combining that with cars. What does your choice of investment options say about you? What are the different types of investments in Ireland? Different types of investment access and routes you can take in Ireland, and providers, and how does that compare to the different types of cars we see on Irish roads? Yes, so this is quite a melting pot of finance and automobile priorities and human biases. Really, I believe it's an interesting topic. Let me just start with saying, right, and this may be deemed controversial, discretionary investment management is like a BMW. Life insurance investment product investing is kind of like a Volkswagen Passat. An advised investment platform is kind of like a Honda Civic. Now, you might think me saying it's like a BMW is a compliment, and that being like a Honda Civic is a negative. But is that so? Is that so? Let me explain. So, this week I'm going to talk about all of that. I'm going to talk about the main options investments and how each of those compares to the different cars that we see on the road, whether they're a BMW, a Volkswagen Passat, or a Honda Civic. And obviously, there's elements of this are tongue in cheek, but there is serious points to this. And what I do hope is that they'll help you maybe stay on a path that you are on, that you feel you actually, on reflection, you should stay on, or if it's to choosing a path in terms of where you are going to get your investment access in future. I had time to make a concise piece, so this week is going to be concise. The first one, in no particular order, discretionary investment management. What is that? This is the BMW, right, in this particular piece. Doing this is basically you hand over your money to a discretionary investment manager, okay? And they manage the investments for you, right? So they don't typically do financial planning or cash flow modeling or looking at the bigger picture. They say, give me your money. Typically, it's a couple of 100,000 upwards for this type of discretionary management. Give us the money and we'll buy and sell individual stock for you. Or if they're that way inclined, they'll try and put you into their own investment products and all that sort of tomfoolery, right? Which is potentially good to avoid that sort of stuff. But the manager will typically buy and sell individual stock on your behalf as part of their discretionary mandate. So they don't need to check in with you. Hey, we're thinking of buying, 40 grand's worth of Allianz or whatever, right? They have the mandate they have the discretion to do so, right? Hence, discretionary fund management. Quick advantages and disadvantages. Advantages can be tax efficient, right? So potentially CGT versus exit tax, potentially, if you capitalize and you realize some gains in future. Can be hands-free for you, pardon the pun, but can be totally hands-free, right? So you can be as engaged or not as you want in that type of approach. Performance can be decent if your portfolio happens to own some of the winning sectors, geographies, or industries. And it feels premium. I'm saying this is an advantage, depends on how you look at things, right? But it does feel premium, right? So there'll be typically upmarket offices, branded umbrellas, very fancy lunches and fancy restaurants, and, all sorts of whiz bangery. It could be corporate tickets to matches and all that sort of premium feel. Okay. That is how they market. That is how they operate, right? Rightly or wrongly, just calling it as it is. Okay. Potential disadvantages of that type of route is high minimums, right? So possibly not for everybody. Fees and charges can be huge. I've seen some outrageous stuff. Likewise, I've seen stuff where it's actually very sensible. Okay, so you want to pick a sensible route there. What tends to drive their fees and their revenues is trade. So if they're doing lots of buying and selling of lots of stuff within your portfolio, that's generating lots of trading commissions and fees. So you want to make sure, again, unless there's some proven rationale for it, which there is not, you want to ensure that the trading fees activity is at the lower end, I would suggest. Another potential advantage here is that many managers, discretionary fund managers, underperform the index. And this is not an opinion, this is a fact. So if you're on informeddecisions.ie and you click the blog that relates to this particular piece, you will see a graph and a picture there showing that in Europe, 92% of funds underperform the S&P Europe 350, right? So the European index, for want of a better expression. The US, it's 90%. So this is not a new thing. We spoke about it in blog 153 years ago. And the SPIVA report, SPIVA, Google it, SPIVA report, see it for yourself. It is a global, I was going to say pandemic, but it's a global fact. Underperformance of investment managers. But that's investment management. That's the BMW. And I'll come back to the car analogy in a little while and explain the rationale a bit further. Number 2 on the list, in no particular order, is the life insurance investment product, the Volkswagen Passat of investing world. And again, that is neither a compliment nor a detraction. What's the opposite of a compliment? Criticism, I suppose. Is it? If you get your advice from an advisor in a bank, or from 99% of the financial advisor brokers in the country, they will recommend an insurance company investment product from your Irish Life, Aviva, New Ireland, Zurich, Standard Life being the main ones. Or if you're a member of a large group scheme, because all of this applies to investment and indeed to pensions. Okay, you can access any of these depending on the scheme you're in. But if you're a member of a large group scheme, the funds that you are investing in are most likely from one of those 5 insurance companies, or a combination of them. The insurance companies are the incumbents in Ireland. They have a huge percentage of the marketplace. I'm guessing 80% plus, but I'd love to hear facts on that. As of 2022, Central Bank of Ireland stated the insurance companies had 164 billion euro of assets of investors' funds under management. So they're a huge player, huge power, huge political power, huge influence overall. Big employers, right? These insurance company products are synonymous with commissions and opacity, with government levy on the way in, with exit penalties on the way out. There is pressure on the central bank, the regulator, to tidy up the whole commission challenges and the conflicts of interest. So we'll see how long they remain the incumbents and how long their particular approach, that commission and, backhanders to advisors and that murky and opacity and lack of clarity for investors, how long that stays around. But they are the most common, most widely accessible route for investors in Ireland. So whether you have $5,000 or you have 5 million, you can access this. Okay? Whether you're saving €100 a month or 100,000 a month, you can access these types of products. Advantages, and again, this is not an exhaustive list of advantages and disadvantages for any of these, but main advantages of the insurance company investing is it's accessible and generally reliable, right? Should do what it says on the tin, mostly. Any tax on gains is dealt with by the insurance company. There's usually a reasonably broad range of fund choices, right, to suit different investor types, and smooth journey and all that good stuff, right? So usually, but they tend to push people towards the middle of the road investing, 4 on a scale of 7 or whatever. Quick and easy to set up, relatively speaking. They're well known, right? And again, I'm putting that as an advantage. They're well known, so people have confidence in that their money won't disappear overnight and it's not a scam, right? Which is important. That they have that confidence, right? And that they actually get invested, which is a huge part of all of this. Disadvantages or potential disadvantages. There's a 1% government levy on entry. So if you invest a million, 10 grand straight away is government levy, so 990,000 is invested. Right. Again, there's allocation rates and all sorts of stuff that can be done to try and combat that. But again, even that fact points to, oh, well, I know you can kind of just magic up 10 grand for me on entry. So again, that's there's a bit of disadvantage and advantage in there. Many options and funds and providers underperform index. Again, tend to be complex products, tend to have higher fees than I suggested, so underperformance tends to be something. Not all cases. Some of them do perform well, and some indeed exceed index, right, during periods. But a lot of them underperform. As I said, a lot of clients and investors end up in middle of the road funds, whether they want to or not. Some bad actors have tarnished the attractiveness and reputation of this type of approach. So people just flogging stuff for commission, people ending up in getting really bad outcomes, having to go down the complaints route, all that sort of stuff is rife with the insurance companies. And sometimes it's the insurance companies, and sometimes it's the brokers, the advisors, the sellers. But that's the reality of it. The opaque and quite often high fees and restrictive terms and conditions is a negative and is a disadvantage that we need to keep an eye out for. Commission structures and incentives for people who are selling these sometimes leads to bad advice or suboptimal approaches for people. There's usually early exit penalties of 5% in the first few years. So if you want to get your money out, you pay a penalty of 5% potentially of what you're drawing out, which can be heavy duty. And then finally, who owns the funds while they are invested? Not yours until you actually draw them back out, technically speaking. Again, that shouldn't be a cause for concern, providing the solvency of the firm and they are in line with the regulation and regulations, EU regulations. But again, something to be aware of and to ask the question on, at least to get clarity around all that. That brings us to the third, last but not least perhaps, is the advised platform investing, the Honda Civic, as I've compared it to here. This approach is relatively new to Ireland, but is the default. If you go to the UK, North America, Australia, those places, platform is the default. If you went and got advice over there and anything but the platform was recommended to you, you'd be like, what the hell is this, right? Insurance companies are not the main providers in those countries. They have moved on. We have not. But if you want to invest via an advised platform, you need a financial planner or financial advisor who is experienced in using that approach. Okay. As opposed to the insurance company commission approach. Full disclosure, the advised platform route is the only route we've ever used at Informed Decisions in our almost 7 years, almost. Jeez. Advised platform is a hugely growing aspect of the investment landscape here. Hugely growing. The demand from consumers for clarity, transparency, access, choice, flexibility is growing. So platform gives those things. I'm giving away the advantages already. God damn it. But investors can ultimately access any globally listed stock or fund that they want to via a platform with full transparency on all costs and charges associated with it. There's no exit penalties or any of that sort of nonsense. No government levy. However, it is close to DIY investing. That's why the advised platform route is what I'm talking about here, where you have an advisor on the pitch with you who should and would be helping with the investment choice, with the future decisions, with drawdown, with due diligence, everything. All right. Like the platform will not give you advice, will not give guidance. That's what the advisor is for. So as I said, the platform is a growing area with the pressure on insurance company commissions, which were banned in the UK years ago, just banned. Commission was banned overnight. 7 years ago, it just changed the landscape entirely. What are the advantages of advised platform investing? Very reliable. You are the beneficial owner of the funds at all times in secure global custody in your name, not anywhere else. Vast range of fund choices from global leaders such as Vanguard, BlackRock, Dimensional, Amundi. Low cost. Again, there is due diligence, there is screening that needs to be done. Again, that's what the advisor is for. There's total transparency on the platform. They are becoming more well known, right? And more trusted. Whereas probably certainly 8 years ago, it was really only the vanguards, the investment vanguards were using platform, or those that knew the industry, knew what was going on. They were really the what's the word I'm looking for? That's on the tip of my tongue. They were the early advocates, the early adopters. But now it's becoming more common. People at parties are talking about it. Oh yeah, I use a platform. Oh, wow, cool. Okay, yeah. So there's that element of familiarity and confidence around it growing. So that's a potential advantage. Lower costs and charges, let's call a spade, than other options when you include advice, custody, fund, platform. Still lower, because you're going to need all those services anyway. But an insurance company and discretionary fund manager, they're all in there as well. You still need those things. You still get them here, but usually at a fair chunk lower fee, 20, 30, 40, 50% lower. All right. And at a very high level of compliance. MiFID 2, look it up. Very high level of compliance required. And this would apply usually to your discretionary investment management approach and to your advised platform approach. MiFID 2 does not apply to insurance investing. Different sort of compliance entirely. Disadvantages of advised platform investing. It's not all rosy. It's no frills, right? Platforms aren't trying to sell you all bells and whistles. They're not trying to make you feel amazing. That's what the advisor is for ultimately. But the platform is no frills. Okay, the focus is on function over form. Platform investing, you have to manage the tax returns. You're accountant, okay? It is something that needs to be self-reported. And as I said, it's a bit of an advantage, disadvantage. It is less well known, right? Means that some are reluctant to commit and to use, and that's totally understandable. All right. Those pros and cons of the three routes, it's fairly high level, right? If you dig into each, there'll be more nuances depending on the providers and the advisors and who's involved, etc. But that will hopefully give you a good rundown. So how does this all compare to cars, I hear you say, right? So I'm saying platform is the Honda Civic, the insurance company is the Volkswagen Passat, and the discretionary manager is the BMW. All perfectly fine cars, in my view. I do like cars. I love looking at cars. I like sitting in cars. I like researching cars. I had posters of cars on my wall as I was a young fella. But I don't allow myself to put a lot of money into a heavily depreciating asset, particularly one that I don't use an awful lot. So that's where I stand with cars. Over the years, I've typically always bought older cars. And yes, they may sometimes have a higher probability of causing issues or needing maintenance or breaking down as you're preparing to go to the ferry to France with a fully loaded trailer and bikes and kids. These things happen to the best of us. And that was straight after getting a service. But anyway, over the years, right, I've owned, and it was an interesting exercise for myself, is I've owned a Mitsubishi Colt, first car, 97L603, a biscuit tin on wheels, a couple of Volkswagen Golfs there followed. These were all probably The average age of the car I've owned has probably been 10 years. Volkswagen Passat, great joke. Really enjoyed that. Um, Ford S-Max, Volvo V50, that was a family wagon. Ford S-Max was a family wagon. Seat Leon was my own runaround. Audi TT, don't ask me. Do not ask me. But was it 6, 7, no, it was probably 8 years ago. Got a Notion, sold the Leon, bought an Audi TT, brought it home. Fiona was like, what the hell is this thing? Couldn't fit a baby car seat into the back of it. It was gone within a month. But I made a couple of €100 in the process. Then BMW 5 Series, again an old joke, but it died of death, and then I just made a burst for reliability. Honda Civic, which is my current run around, and Ford Galaxy is the family bus. Nothing exciting, all right? Clients were into the discretionary fund management. Typically speaking, if they see me pulling up in an old Honda Civic, they were like, what is the story with this fella? He doesn't have a cent to his name. As I heard one time, maybe, but I prefer to keep my new car in my bank account. Anyway, over the last couple of months, I've been thinking about changing the Civic for something a bit more decent. Nothing outrageous now, but upgrade a little bit, right? Because there's a line, isn't there? There's a line about, look, there's a bit of frugality and a bit of common sense there, but that's just a bit rough looking. So I've been looking at cars, and at various stages, I've almost decided on a BMW 3 Series, BMW 5 Series, again, older ones, right? A Volkswagen Passat, or indeed just keeping the Civic, but getting a slightly newer Civic, fresher looking. I've yet to bite the bullet, right? But I'm enjoying observing my own biases and what's driving the various decisions as I look at it from time to time. And that's what led to today's post, really, and this piece. I can see what drives me, pardon the expression, but invariably what drives a lot of people when it comes to choosing their investment sources. And here's where I'm going. Discretionary investment manager, BMW. The investor will be made to feel that they're getting luxury. They're getting personal care. They have somebody looking after this, right? And something that most others can't access and don't have access to. They'll get a bit of an ego boost maybe if they tell their pals over canapes that they're invested with, hammer and tongs on Fitzwilliam Square, for example. They know they're possibly paying higher fees for their service, but they feel the luxury is worth it, right? That sense of care, perhaps it is, right? But like BMWs, they typically will need a lot of maintenance, costs will be higher, but it might feel nice. Right? That's the reality of owning a BMW, having had one. What about life insurance investment product? This to me is like the Volkswagen Passat. The investor here will know lots of people have done this before me. All right? Mightn't be the best thing in the world, but shouldn't go too far wrong here. Common approach, tons of them on the road. All right? They should keep me between the ditches without any major drama. All right? Probably won't deliver anything exceptional, right? But they should be grand. But much like with Volkswagen, beware of any claims that they make about the level of emissions or the fuel efficiency. Fees have proven to be way higher than claimed in certain cases. Hence the comparison. What about the advised platform then? I'm saying it's a Honda Civic. It mightn't be the prettiest at the party, but by God will it deliver. Savage value for money and mighty efficient. And it'll be fairly zippy, delivering really nice performance if you drive it properly. And speaking of which, your advisor should be an experienced hand at the wheel. It's like getting chauffeur driven in a Honda Civic, basically, is how I would compare it. Keep it between the ditches and point it in the right direction at all times. Might be a bit noisy, a bit rattly from time to time, but you just drive that on. Keep her lit and she'll get you where you want to get to. High probability. And you will be tempted, and you're sitting in the back of the Civic. Jesus, I could afford better. I really could afford better than this. You might be tempted to jump into the Beamer for a while, for a bit of comfort and luxury. But if you do, I can tell you, you'll be quickly pining to come back to the Civic. No question. That's my thoughts on it. And I realise this is not empirically verified. That would be really interesting research, right? If somebody knows where to start with that, to research types of investors using different routes and the types of car they drive. How would we gather that? I am actually speaking to a university in the US, somebody that was on this podcast about doing research here in Ireland to see how it stacks up versus the US and where we're at with regards to literacy from consumers. Maybe it's something we could plug into that. Wouldn't that be interesting? But look, this is not empirically proven or verified. It's a bit tongue in cheek, but I do hope it's helpful. As I said, hopefully there's a couple of nuggets here that might help you either stay the course with what you're doing or assess your options in making an important decision. And personally, I may end up buying an old BMW or a Passat or sticking with the Civic, right? But that choice won't influence my own preference for what I believe is the right investment route for me. I hope this helps. Thank you very much indeed for listening. You're a legend.